Well, let's introduce our very first guest on the show. Abhinav Angirish, founder of investonline.in, joins us now. Abhinav, thank you so much for giving us your time today on the show. The idea is to understand the entire gamut of categories in the mutual fund universe. We are, of course, very familiar with large caps, mid caps, small caps. The name is obviously very simple to understand that, a large cap fund invests in large cap stocks and so on and so forth. But there are so many mutual fund categories out there. So the idea of this show is to sort of understand that what kind of fund is suited for, what kind of investor, depending on their risk objective, their different financial goals as well for which they are investing. So Abhinav, let's start off first with what are the different varieties of a mutual fund that are available for a retail investor to invest in?
Hi, Abhinav. Thank you for having me here. Okay, so broadly, I would say mutual funds are categorized in 5 different categories. The first one, like you mentioned, is equities. Second one being debt. Third being hybrid. Fourth being solution-oriented. And there's a fifth broad general category, which we call as others. To further, break these up into what these are, if you look at equities typically are large caps where you are investing in large cap kind of companies. Multi-cap has basically a mix of all kinds of caps, with a large cap, mid cap, and small cap put together in one fund. There's another category called as a mid cap, then there's a small cap. Then there are other diversified categories. There could be a contra, kind of an exposure, a value fund strategy, or a tax saver strategy. And then there are sector specific, industry specific investments too. Now, these are all equity related. So depending on a risk appetite, you need to choose which fund you want to be in. Then you get into debt. Debt typically ranges from very short-term investments, which are overnight funds, as low as a day or two kind of an investments, going to liquid funds like 7 days. There are duration funds where you can choose low duration or short duration funds, followed by corporate bonds, which are slightly longer period. Then there is credit risk, and then there is government gilt. These different categories, again, depending on what kind of duration you want to really invest. Hybrid is an interesting category. So you typically have 3 categories, which is aggressive, conservative, and moderate. In these, it's a mix basically of different assets. It could have equity and debt. It could be a multi-asset category, or it could be purely be an arbitrage category, which is just probably looking at arbitrage opportunities between the cash and futures market. Again, depends on what kind of investment horizon you have, and if you're looking at getting slightly higher returns compared to what your fixed deposit does, hybrid is the way to be. Then you have solution-oriented categories. These are typically nothing but equity categories, broadly equity and hybrid, more aggressively on the aggressive hybrid side. But they are called solution-oriented because the names of these schemes typically would be like retirement funds or children's funds and so on. That's why they're called solution or goal-oriented kind of funds. And the other category, like we spoke about, are index funds or fund of funds, international funds, and so on.
So, how exactly do these funds work in an investor's portfolio? Do they sort of address specific goals? Who should invest in what kind of funds, rather?
So, Mubina, all investors typically should go through a process of financial planning, by virtue of which is, you can derive where you want to be invested in, which category you want to be invested in. So this is broadly derived from your risk profile, right? So you could be a very aggressive investor, or you could be a very conservative investor. You could, naturally be very young in age and take the exposure in equities, or maybe you could be young but don't have the risk appetite to see your movement of your portfolio on a regular basis. So the category of fund selection will depend on what your risk profile is. Once your risk profile is determined is when we come to a conclusion of what your asset allocation should be. When I say asset allocation, I mean how much amount should be invested in equities. Because if you have a long-term goal of 15, 20, 30 years, I will categorize you as an aggressive investor. But if you have a shorter period and you have a family coming on the way, so your category and your risk profile will keep changing depending on your financial goals and the stage of life that you are in. When you get closer to retirement, we get conservative and we get more into debt kind of investments. Now, selection of categories, whether it's a large cap investment, mid cap or small cap, also depends on risk profile. There are aggressive investors but they don't want to take the risk of mid cap and small cap because they are really high alpha generating categories. But if you stay over a period of long term, yes, you do make money, but they don't want to see the short term blips comparatively of what you see on large caps. So we would not choose a mid and large cap, mid and small cap. But if you do have the risk profile, we can give you those different categories. Now, if you're a short-term investor, where you're looking at talking short-term amounts, probably for education or maybe for emergency or any such purposes, we go to the debt category. But if you have a period of 2 or 3 years in place, we can choose a higher debt maturity products like, corporate bonds or credit risk funds and so on, or even gilt for that matter. Gilt can go as high as 10 years because that's government gilt. So it all depends, again, what your risk profile is. If your risk profile suits your requirements, and if you're happy to see what your funds can do or investments can do over a period of time without stressing about the short-term volatility, your asset allocation can be set correctly. And it's very essential that you do maintain asset allocation at all times, regardless of market movements. So 2020 was a great time to actually judge this, and you could, test yourself whether you could take the March pressure. People who did are bearing the fruits today. People who did not actually exited and moved out of the asset allocation and are probably losing out on the gains in the equity markets.
Okay. Understood. So it really depends in a large part also on what your time horizon is, because that will essentially determine what kind of fund as well that you should invest in. I want to know your view on these solution-oriented funds. Many a times mutual fund houses have children education funds, retirement funds, etc. How do they really differ from, a large cap fund or, like you mentioned, right? If you have a short-term goal like an education fund, which will be which will be coming up in the next 3-4 years, then you invest maybe in a hybrid fund. So how do those differ from the funds that, specifically state their goal?
Okay. So solution-oriented schemes are, I would call them, they're more of an emotion connect with the investors. Why I say so? So let's assume a situation where you see a retirement fund, right? When the word retirement comes into play, you are talking about an investment which probably should start reaping the benefits once you're 60. Typically, all these retirement funds which are currently there in the market have kind of a lock-in till age 60, and post that is when you can start withdrawing the money. Now, the reason to have this is purely to, kind of generate discipline among investors that these funds have to be locked and you have to look at them for the long term, just the way 25 years back used to look at insurance schemes, right? Insurance schemes like LIC would have pension plans and retirement plans and children's plans and so on. The idea is that if you have such funds, at the back of your mind that these investments are going to be for a specific goal and they're going to be invested for that period. So for children's fund, if you have a newborn, you want to invest for the child's education. So, you're going to use these funds only after 15 or 20 years. Unlike a regular fund, where you will have the option of exiting whenever you want because they don't really have a lock-in as such. Number two, if you look at it from what the allocation of these funds are, broadly, they are equity or aggressive hybrid funds. Of course, you have an option of choosing a conservative and moderate option in retirement funds also. But typically, they are equity funds. They're nothing but your open-ended equity funds or a hybrid fund. It's just that the name classification is such which makes you stay invested for the long term. I mean, 20 years back, like I just mentioned some time back, when you had LIC premiums due, it was more like a challenge to ensure that you have to keep paying the premiums for the next 20 years. And that's why the discipline set in. And that's when you used to get the large corpus at the end of the tenure. These are nothing but same funds with no cost of insurance and much lower cost of expense ratios to be managed as well. And hence, they're more, I would say, discipline-oriented funds than solution-oriented funds.
All right. Very quickly, I just wanted to get in your take on mid caps and small caps, because the last few weeks we've been seeing a lot of activity in that part of the market. For 3 years, many mutual fund holders have been complaining about how these portion of their funds are not really performing. So I wanted to take in your view on, what you're seeing in mid caps and small caps.
See, yes, like you mentioned, Mubina, last 3 years have not been great for the category. Even after the March fall, the comeback of mid cap and small caps took some time. It only happened close July, August. but the comeback has been huge, right? So if you actually see the index, it's practically grown 80-90% from last year's fall. These are aggressive funds, right? These funds, when they gain momentum, naturally, because there is so much value inherent in mid and small caps, that when they start growing, sky is the limit. But at the same time, when markets are negative, everyone wants to run to safe havens, and that's when money start moving from mid and small to large caps. But if someone is investing for 15, 20 years, and if you go back and see history, there is no way any large cap is even close to the returns of what even an average mid and small cap fund has. So we also suggest to investors, when they're looking at SIPs or looking at long-term investments, SIP again being a rupee cost averaging product, be in as aggressive schemes as possible, because your purpose is rupee cost averaging. More aggressive the scheme is, better it is for you, because averaging always gets better. But please keep in mind that 10 years to 20 years is the least you should have for these kind of investments, because they are very aggressive. They can generate fantastic alpha in the portfolio, but at the same time, you need to have patience. So investors who actually gave up, in the last year again, after those 3 years of dry run in mid and small caps, today are losing out on the benefit of what these indices have done in the last 6 or 8 months. So again, holding on in patience is great, but you need to have a larger horizon, a time horizon specifically for this category of funds.
All right, great. Well, on that note, I think we'll have to just slip into a very short break. I request you to stay on with us. Abhinav, we'll be back and we'll be answering our viewers' questions and queries as well. So if you'd like to ask Abhinav anything on your portfolio and how you can go about effectively investing your money, write into us. Our email address is themoneyshow@etnow.tv.